Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Kevin Davitt, Head of Index Options Content at Nasdaq, Nick Smith, Head of Index Options, and we have Mike Duncan, the Portfolio Surgeon, who heads Para Bellum Advisors. We're here to discuss growth stories. They're not uniform. The embrace of capital efficiency and risk management using derivatives is expanding globally with the help of firms like Para Bellum. Today, we'll discuss Nasdaq's global reach, the appeal of Nasdaq 100, and the value of working with trusted advisors. It is great to have everyone with us. Welcome to Trade Talks. Kevin, let's kick this off with you. Nasdaq's global footprint continues to expand. What's driving engagement across regions, and how is it translating into investor access and opportunity?
First off, thank you so much for having me back, Jill, and happy Thanksgiving week. I think that there's a handful of really powerful forces that are driving Nasdaq's growing global footprint. First off, I would point to Nasdaq's massive name and brand recognition. So I grew up in like the golden era for the Chicago Bulls, where people everywhere knew Michael Jordan. And NASDAQ has that type of reach. You talk to investors in the Middle East or across Europe or in Asia, they all immediately recognize NASDAQ. Now, beyond that, there's the performance of NASDAQ's most well-known index, the NASDAQ 100, which both myself and Nick support. Investors want the type of exposure that the NASDAQ 100 provides. ETF flows in the US validate that belief. We are seeing very, very significant flows in other types of fund structures like UCITS in Europe and across Asia. Nick could elaborate a bit on that. The wrappers might have different names, but the securities behind it make up the NASDAQ 100. Then you have the likes of Nick and his contacts like Mike Duncan, who understand the use cases for risk management tools like index options. They're establishing relationships across geographies and they're getting buy-in. And that is how stories like this evolve. Individuals and institutions globally have been clamoring for US exposure, and increasingly they are looking to point those assets toward the NASDAQ 100. My belief is that that trend will only accelerate in the coming years.
And Mike, Para Bellum works with institutions across Asia and globally. Where are you seeing the sharpest demand for capital efficiency and derivative-based risk management? And what do you think is driving that shift?
Okay, I guess, for me, what I'm sort of seeing is generally institutions where somebody's got some skin in the game. So if I'm dealing with sort of partners or someone very close to someone who's very keen about how capital is treated as a precious resource, I find a lot of interest there. And unfortunately, the answer should be everybody should be keen on this, but it tends to be the bigger shops that are not so much as aware of it. And why is this? It's like on a relative basis, when I talk about these sort of smaller players, it tends to be that, for them, everybody capital is a precious resource. They'll look at it to be leaner, meaner, and more of a machine. And if someone's sort of connected to the cash at the end of the tunnel, they tend to be very concerned about performance and working capital optimally. It's like if you sort of say to someone, I can give you an extra 50 basis points on your 100 million, a logical person will sort of say, hey, 500 grand, yeah, I'll take that. Whereas some of the bigger guys are like, yeah, it doesn't fall under my radar and things like that. So the guys I'm sort of seeing a lot of the demand coming from is basically where they're connected and have some form of skin in the game, which is kind of obvious, and it tends to be that even if you don't have a P&L statement or a specific item that sort of itemizes these sort of things, if you walk them through it, if you can save them money and if you can boost returns, bang, they're suddenly very interested. And I guess, most of the guys I sort of deal with tend to be working on a real-time sort of basis, they really do feel the difference between a 50 or 100 basis points of extra boost on what they're doing, and if you can sort of show them how they can do that, they're very interested in talking further. And I tend to sort of find that a lot of these guys tend to sort of be focused on specific core areas of expertise and things like that. So like you sort of think of me as somebody outsourced derivatives sort of specialist who can sort of show them how the derivatives can leverage their performance, I guess in a nutshell. And I guess the best sort of case of example is if hypothetically you had an exposure to Nasdaq 100 options, sorry, Nasdaq 100 in the physical sort of world, like you can sort of switch that into derivative sort of overlays whereby rather than say $100 million investment in the Nasdaq 100 physically, you can sort of revert that to say the futures or the options, where rather than paying $100 million outright, you can sort of do it for sort of like 6 million, on the margin and things like that. So when I talk to a lot of these guys about, their exposure, it's like, hey, like suddenly there's an extra bit of leverage in what they're doing, and it gives them much more resilience and sort of performance, whereby if I suddenly have out of $100 million exposure, I'm only paying, say, $6 million, I've got $94 million I can sort of put into other things. Like if you're very conservative, you can go to T-bills, so you can get an extra 400 basis points uplift just on the back of that. So a lot of guys are interested in that sort of thing.
And Nick, you have a global remit in your role as head of options index sales. You cross paths with Mike at Davitt in Hong Kong. There's clearly demand percolating across the world for exposure to our markets. Explain how Nasdaq and our index risk transfer business help institutional clients.
Yeah, absolutely. Thanks, Jill. Thanks for having me again. There's really three markets within the market that I want to focus on today. So the first is the ultra short dated retail driven flow, because the Nasdaq 100 index option is available on a number of retail brokerage platforms. And institutional quant firms will often look to interact with that flow, not just our market makers, but also the hedge funds that seek alpha in that type of market. In the longer dated flow, there's really two use cases that I think of, and it's very nuanced, and I'm simplifying here, but it gives you an idea. The first has been referenced already. There'll be asset managers who have some sort of underlying exposure. They may even be a bank that's a swap counterparty to an ETF, like the vehicles that Kevin referenced earlier. Could be a money manager with an equity portfolio. And they will look at the longer dated out of the money index options as a protection for those returns, or what's often called a hedge. The other use case, which we see a lot, and we go to conferences around the world, such as the EQD Asia that I met Mike at in Hong Kong, where a number of what are termed volatility managers are present at that conference, and they look to essentially exploit or weaponize that hedging tool by buying very cheap options and using the convexity, which is a fancy word for something that will change rapidly given a certain environment, in order to generate returns in particular environments, and trading the volatility as an asset class with these index options products. And as mentioned earlier, the underlying of this product in particular is the Nasdaq 100, which increasingly is seen globally as the default go-to when considering US equity exposure and derivative exposure thereon.
And Mike, people call you the portfolio surgeon for a reason. You're known for slicing through portfolio complexity and removing performance drag with derivatives and capital management. When markets get stressed, what really determines whether a hedge actually delivers?
Okay, so there's a bit of a debating point here. It's kind of like offsets a lot of people, I find. So for me, it's all about monetization. So like I've sort of like done a lot of research in this area and sort of been through the sort of the hard yards myself. And in a lot of the cases, like I think a lot of people work hedges really badly, and we're just talking basic hedges. So for tail hedges especially, there's kind of like this this how we could sort of say fear, So yes, people should have tail hedges, but I find where things go wrong is that on the monetization sort of things, people don't actually have a plan in place to actually liquidate when they should, and they get sort of confused about things like, hey, our hedge has suddenly gone from like nothing to like 500-600 times return, and that's good, except as soon as they get into a committee or something like that, suddenly that hedge can dissipate rapidly. So we've sort of seen that in the early 2020s, and I've been through that experience myself. When you've been up a couple of $100 million and suddenly it's just evaporated because someone won't let you do the next sort of stages. So I'm all about the monetization, and that's a little bit of clickbait there, just in the sense it's to sort of hammer it home. But when we talk about tail hedges and the sort of the outcomes that what they give, with things like, say, total portfolio approach and all that sort of stuff, like a tail hedge and those sort of tools and frameworks give the ability of a portfolio as a whole to just be much more resilient. So not only can you sort of save yourself in a time of crisis, but you can also, if you have the frameworks in place, not only can you sort of potentially profit from it or at least sort of come out not too bad in the initial sort of stages, but you can also use the benefits of compounding and resilience to suddenly sort of clean up in the situations where everybody's looking to sort of liquidate as fast as they can. And you can sort of see this with like old school traders and portfolio managers. You know, when things happen, you know, they know exactly what to do, they know exactly what to go. And that's why some of the top sort of performers out there, you know, like they have plans in place, they know what they're doing before they happen. Let me rephrase it. So they know what happened, you know, they know what to do when the crisis hits. And this sort of reverberates across tail hedges and just basic hedges in principle. And I mean, like, I'm talking to a lot of people now, or even basic hedges like FX overlays, like people aren't even thinking about monetizing them. They just go through the checkbox sort of process, like, oh, I've got a hedge in place, well, cool. And if it's in the money, they don't actually do anything about it. So there's a lot of money left on the table, and it's like core aspect of what I'm trying to do is trying to sort of prevent that money being left behind and sort of like actually boost returns and stuff. Yeah, and I guess you could sort of say the benefit to having resilience with these sort of tools and frameworks in place is this, you know, like it massively makes your portfolio so much better than anybody else who's not sort of taking these things into account. And it's doesn't even have to be sophisticated, you know, like definitely you can take volatility as an alpha and things like that. But it's just like having that actual basic framework in place can really sort of like compound your returns and compound your performance. And at the end of the day, like, you know, if you drop 40% in a portfolio, it can take you about like 5.5 years at 10% to regain where you were. Whereas it's sort of someone who sort of knows what they're doing and all that kind of stuff, has a minimal impact, maybe they're down like 0 to -5%, they can come back very quick. And then also the compounding benefit from buying up assets on the cheap just gives them leaps and bounds ahead of everybody else out there. And quote Forrest Gump, that's all I have to say about that. But I guess the best analogy, if I can sort of go there, is kind of like if you sort of think of the average asset manager as running a Formula One car on a racetrack, you know, like this is not my analogy here, but it's kind of like a lot of these guys are running these cars without brakes, right? So tail hedges and sort of frameworks like that, you know, sort of you can sort of think of them as having brakes. So in the good years, they can go hardcore, you know, and then when they sort of come into the periods of crisis and stuff like that, rather than skidding off the track, they can apply the brakes and then just really ramp things up. And that's why you can sort of see with the top performers out there, you know, they know what they're doing. They just put money into the things, get the good systems, get the good frameworks, and they really make returns and they make it look easy. And it's like a lot of it's just, it can be very systematic.
All right, great insights from all of you. Mike Duncan, the portfolio surgeon from Para Bellum Advisors, and of course, Nasdaq's Kevin Davitt and Nick Smith. Thank you as always for joining us on Trade Talks.
Thank you. It was a pleasure.